Hey, this is Nick from Income Digs, and welcome back to our series on using QuickBooks for your real estate investing business. We're on Module 5 here. We're going to talk about selling and refinancing property. I got a lot of awesome stuff to demo for you today, but I also want to remind you that if you're interested in our end-to-end course, full detail, everything that there is to know about QuickBooks for real estate investing, if you're a bookkeeper or an investor yourself, check out Real Estate Accounting Bootcamp, our end-to-end course on that subject. But let's get into it today. We're going to talk about how we can continue to make QuickBooks a really useful tool for our business, and again, selling or refinancing a property. And when it comes to selling or refinancing, it's really about removing or replacing assets from our books. And we all do this, whether we're a long-term investor or we're a short-term flipper. We're going to be moving around assets and recording the sales and refinancing of things really frequently within our business. So we want to make sure we have a firm understanding. And if you want to compare this to Module 2, where we talked about purchasing property, this is something that's very important to the business. We might do this 1 time a year, 2 times a year, 10 times a year, 20 times a year, whatever the case is, it's still very important. And I want you to lock in on this process, treat these transactions really seriously, because they really are the lifeblood of your business and your whole accounting books, all right? So when we talk about selling or refinancing a property, I'm going to demonstrate 3 different examples for you today. The first is removing a long-term asset from our books. So think about like a long-term hold, a rental property that you actually sell and get rid of. The second is flips. We're going to talk about how flips are a little bit different. We bring in a component of the profit and loss. We may or may not use that. I'm going to talk about those scenarios and how we can differentiate the two. And lastly, refinancing. And this is something that's very, very popular. This could be for a long term. This could be for a flip. Whatever the case is, getting new loans. Whether we had a loan before and we're replacing it, or maybe you bought the property with cash and you're financing it for the first time, we still call that a refinance. So I'm going to demonstrate all 3 of those examples for you today. All right, let's get into QuickBooks. The rest of this, I'm just going to teach right within QuickBooks, right, with these 3 examples. What I'm going to do is I'm going to go back in time. I've got kind of like 3-ish different time periods that I'm going to go through these examples. 2016 is going to be my long term. Second half of 2016, I buy a flip. I'm going to sell that flip in 2017. We're going to do a refinance of a property in 2018. All right, so we're going to go on that journey. Over to my right is going to be a HUD that we're going to be referencing here and there. But let me dive into my balance sheet and let's start talking about what we have here. So what I have on the balance sheet right now is a long-term, residential rental property, okay? And we're almost always going to put that in our fixed assets. So we're going to differentiate our building. We have our closing costs. We have our CapEx here as well. And just for good measure, why don't I add a little bit of depreciation? So that's one thing that you'd have as well. So I want to make this realistic. I'm going to put this back in time. Let's go 8/31/2016. Now, your depreciation, I have videos on this in my end-to-end course, and that's always going to be at the end of the year. But just to demonstrate this, I'm going to put it right here. I'm going to depreciate my building a certain amount. Now, I'm not going to do any kind of depreciation calculations here in QuickBooks. This is something I'm going to work through with my tax professional, but I'm just going to put something arbitrarily in my books so I know how to kind of deal with it here. Okay, so I'm going to put just $45.50 in depreciation so we can just see that show up on the books as well. All right, so let me save and close that, and I want to see how that impacts my balance sheet here. There we go. And this is a little bit more realistic. So we have a property that's worth $650,000. We put $6,400 toward the close. We put $175,000 into it from CapEx, and then we depreciated $45.50. Okay. And we're going to then sell this property. Okay. We're going to sell this property for $1 million. All right. So this is an example of a HUD statement. Now, this is again arbitrary. So some of these things you might say, well, why is it that much? Why is it that little? Don't worry about the actual numbers. I just want to track through how we treat this. When we're looking at the sale, we're looking usually at this right side of the HUD. Your HUD might not look like this. You might just have a generic closing statement, but it's all going to work the same. Here's the proceeds that I am due. And then here's some stuff that I may be paid for ahead of time that I'm going to kind of be due back. And then I owe some money as well. In this case, I owe a loan. All right. We're going to talk through that. I owe RE commissions, real estate commissions, transfer tax as well. That's going to lead me to only get back $86,000. Actually, that's fine. I'm going to get back $86,000. So what I'm going to do right now is record this sale. Now, when it comes to recording the sale or recording a refinance, what's important is that we have a really accurate snapshot of our balance sheet the day before we sell this thing. Okay, what I mean by that is you need to make sure that your accounts are accurate. it starts with the assets. This is something that you want to have as accurate. Make sure your depreciation's in there. Make sure that this is up to date. Your loan balance, you want this to be accurate as well. Check with your statements and make sure that what you have in QuickBooks is exactly what your bank says that you owe. Similar to that, on the same line, is your tax and insurance escrow. Do you have funds sitting in a tax and insurance escrow for your bank? This is so important because when it comes to that payoff, usually what's going to happen is your payoff amount is going to be something that's different than what's in your books. That doesn't mean you're wrong. What that means usually is that this payoff amount includes not only the principal, in this case the $785,000, but also some unpaid interest. And yeah, by the way, they're going to pay back your escrow account. Okay, that's a negative. All right, so you want to figure that out. And that's the work you do before you start making the journal entries. You want to make sure that when you start getting into the journal, as you work to eliminate assets or liabilities, it's going to work for you. All right, let's do exactly that. I kind of have this here ready to go. And so this is kind of something you'd want to take a snapshot of. The main goal in doing a sale transaction is you want all of these to go to zero. These are going to go to zero. Your private money loan is going to go to zero. Your tax and insurance escrow are going to go to zero. So we need to make sure we have those balances ready and accurate. In fact, I'm going to open this in a new tab so that I can kind of click over and reference it here and there. Okay, so it's over here. Great. Now I'm going to create a journal entry. All right, so the journal entry is going to be on the day of the sale. So in this case, I'm going to do let me just do 10/31/2016. I think that'll work. All right, first thing I want to do, this $1 million is interesting to me, but right now I want to zero out my assets. So I'm going to zero out my building. I'm going to zero out my closing costs. Okay, I want there to be no record of this, with zero balance of this property when I'm done with it. I'm selling it. I no longer own it. So my closing costs, my building, my CapEx, kind of looking over here, is my building, closing costs, CapEx, and yeah, depreciation as well. Okay, so we want those to get to zero, so it's relatively easy to do that. Instead of debiting them, we're going to credit them their exact amount. So $650,000 for the building. Closing costs is $6,400. Notice that I haven't even looked at my HUD yet because this I have to do regardless of what my HUD says. $175,000. Okay, I'm getting this down to zero. Now this one's negative, so I will debit this $4,550. Okay, what you could do, I actually like doing this, negative $4,550. So it's actually a debit of a positive $4,550, but the negative helps QuickBooks give me my calculation, this $826,850. I like to see this all in one place because the next thing I'm going to do as I add class real quick, the secret equation to selling property or to refinancing property, actually to selling property, is your realized gains, which is going to be the money you make, the income you make on the sale, is going to be your sales price minus your basis. This $826,850 is my basis. We know it right here, $826,850. That's my basis. So all I'm going to do here, this is going to be my realized gains. This is an income account. Okay, it's going to be 1 million minus 826,850. Okay, 173,150. That's perfect. And this is the first step of recording any sale, is to get your credits to match exactly the sales price. And I've just done that. I've accomplished that perfectly. All right, now we're going to add in some of these other credits. So they owe me some taxes here. Okay, so this is a situation where I probably paid them ahead of time, paid these taxes ahead of time, but I didn't own the property for long enough to reap the benefits of those taxes, so those are owed to me on the sale. This happens very frequently. Usually there's some credits, there's some debits on taxes. Sometimes you owe a little bit, sometimes you get a little bit. All right, so there's my 1.001695. That matches here. Now it's time to pay off the loan. And what we start to do is we do hard money loan, and we would want to debit this $845,320, but that's not going to be accurate because, as we talked about, we've got principal, interest, and escrow making that all up. So we need 3 lines for that as well. My principal is only $785,000. Okay, so we have that in there. We want that to go to zero. If I had anything else in there, it would not go to zero. Interest is a cost of goods sold. So I owe $62,800 in interest. That's like a prepayment penalty or something like that. It's obviously a big amount there. Or maybe it's interest has been accruing and I haven't paid anything yet. So it's like interest is all due at the final. And then my tax and insurance escrow currently has a positive balance of $24.80. I'm going to bring that down to 0. Whoops. And again, I can go here and do a negative $24.80. Okay, to give that $845, $320. Now I owe some real estate commissions. And so that's going to be like professional services is usually what I do that as, legal and professional services. I owe $60,000. And then I owe transfer tax as well. And that's going to be legal and professional as well. That's how I'm going to treat that. Okay. Now we don't put any selling costs on our balance sheet because they're over. It's, I'm done incurring them. There's no point. The property's off my books. All right, that's kind of the last thing. And just like we did with the purchase, this kind of magical moment, the cash in the previous case was cash due at closing. Now it's going to be cash that I receive at closing. It's going to be deposited into my checking account. This is going to be $86,375. Perfect, right on the money. Okay, now I'd want to probably put in the descriptions of everything there is. I'd want to save this attachment here as well. But what is going on here is I'm capturing all of the credits and it's eliminating my basis, getting it to 0. The difference is my realized gains. I've got some credits in this case for property tax. And then I owe back my loan. I pay some interest on that. I get paid back my tax and insurance escrow. I've got my real estate fees, my transfer tax, and finally I get cash at closing. Let's save and close this transaction and see how it impacts my balance sheet. All right, so my balance sheet through October, in this case of 2016, there's my checking account, has now been replenished with that $86,000. My private money loan is gone, and my net income has updated as well. Let me just drive into this for a second and see where this has come from. There's my realized gains. Then I had my legal and professional, I had my interest, and so there is my total net income. Perfect, right? That's selling a property, a long-term asset. And I'd say the trick there, the real focus point, is to understand what your balance sheet is at the day before you close and get those assets and liabilities to 0. Okay? We're going to go on to the same kind of property. We're going to sell it for the exact same amount, but I want to talk you through what if it was a flip. So in this case, I'm going to have a flip on my balance sheet here. And when I say on my balance sheet, it's actually on my balance sheet via net income. All right, so if you recall from our purchase, when you are recording a flip, you may add it to your cost of goods sold. This is typically what I'm going to do, okay? Now this is my realized gains for the entire year, okay, which I don't want. So those realized gains are going in there. We'll get rid of that eventually. But here's my purchase price, my buying cost, my holding cost, my rehab costs. So typically what we're going to do with this is, let's say that I sell this property in 2017. A really common thing to do would be to move all this over to your balance sheet so that tax year 2016 does not have massive losses, okay? So we're going to do that. I'm going to take these costs right here, okay, including my debt service, and I'm going to move it all over to the balance sheet before I sell this thing, okay? So again, I'm going to kind of, let's save that over there. Let's do a journal entry for that move. All right, so let's say that I sell this thing not in 2016, but in 2017. So I'm going to do a journal entry at year end 2017, 12/31/2017, to make that move. And basically what I'm going to do is I'm going to take all these cost of goods sold accounts and I'm going to bring those to 0. So I have my purchase price, I've got my buying costs, I've got my holding costs, my rehab costs, and lastly, my debt service. Okay, and I'm going to bring all of those to 0. So I have $650,000 purchase. Oops, let's go up here. My buying costs, flip back over here, $6,400. My holding costs, $2,067.20. Rehab costs are exactly $175. And my debt service is at $24,324.25. Okay. Now, a word on holding costs. Holding costs, you can certainly deduct the year they're incurred. So it's really up to you and your tax professional. I honestly think it's easier to keep it all in one to keep it consistent, meaning the insurance that you're paying for, the property taxes, you could deduct that all in the year they're incurred if you want to, but we're going to do it all as one here. Now, I'm going to offset this with my flips in progress. So I have flips in progress is going to be an inventory account. Okay, so flips in progress, I'm going to have all those same accounts as balance sheet accounts. So I'm going to do my purchase price, I'm going to do my buying costs, I'm going to do my holding costs, rehab costs as well, and my debt service. Okay, and so here we go, 650. Buying costs is 6,400. Holding costs 2,067.20, and my rehab costs of 175. Debt service 24,324.25. All right, let me just put my class, and as I'm doing that, let's talk through exactly why we're doing this again. The idea here is that we bought a flip, we renovated a flip in a year, but we didn't sell it yet. So when it comes to tax time, I don't want my net income to show a gigantic negative. Okay, I want to carry that project forward until I sell it. And what's awesome about this is that for tax year 2016, my bad there. For tax year 2016, okay, we're going to check the box there. And then on the first day of 2017, I can like flip the switch to just kind of reverse that transaction over. Okay, so here, see at the end of 2016, I've got all of those items are now in here, flips in progress, all of those accounts here, and my net income is way less negative. Okay, and now on 1/1/2017, okay, that's where I start my books, but I'm going to do kind of the reverse of this. So I've tackled the aspect of the tax prep. Now I'm going to take this exact journal entry. Let's grab this exact journal entry. You could reverse it. Okay, so I'm going to do exactly that. I'm going to reverse this transaction on 1/1/2017. I just click the reverse button and it creates a copy and it reverses it. All right. I'll save and close that. Now, if I go to my balance sheet as of 1/1/17, everything's been moved back to the P&L. There it is in my P&L. Now I can continue on with my flip. It's up to you on whether or not you want that to happen or not, but I'm kind of getting the best of both worlds. I was able to account for my taxes, and now I have this giant net income, which is what I want as a flipper, because now when I sell this property, it becomes very, very simple. Okay? So let's do just that. Let's sell this property. Now, selling this property, I have the same exact loan that I had before, same exact tax and insurance escrow. Now we're going to sell it, but this time it's a flip. Okay? So let's go to new journal entry. And we're going to sell this as of, let's say, 6/30/2017. Okay, here's the biggest difference when it comes to a flip. Because I moved everything off of my balance sheet, for when it comes to an asset, I have nothing left in my basis to mess around with. All right, so this entire $1 million can go all to revenue. It can go all to sales price. And in my experience, this is where we want to see it. Okay, there's my flip selling price. Okay, most of, myself included, when I sell a flip, I want to be able to see the total revenue up at the top line, meaning I want everything off of my balance sheet. So I'm going to do my $1 million right here. So these are really a lot easier because it's just one line instead of all those five. All right, so that's my entire selling price. And then I still have now my selling costs. Okay, so usually as a flipper, I'm going to have selling costs a little bit different. And here I'm going to have, well, actually, this will be holding costs for these taxes. So let me tackle these holding costs first. I have some credits here, $1,245, and then another holding costs of $450. Okay, so there's, I'm kind of doing the exact same thing I was doing, but now my credits are just a lot simpler. Okay, here's my existing loan payoff, same exact thing. I'm going to do the principal as private money loan. Okay, I'm going to debit that, $785, bring that to $0. And I have interest that I owe as well, so that's going to be debt service, $62,800. And I have my escrow account. Let's do a negative 2480. I have RE commission, so that's going to be selling costs. Now, you're noticing that I have kind of some different accounts for flips. I do that. I have my selling costs as opposed to like legal and professional services. For rentals, I'm trying to keep everything close to that Form 8825 from the IRS. For flips, it's a little bit more free for me to do this as selling costs as my kind of categories here. And then last thing I'm going to do is cash at closing. Now the cash at closing is going to be exactly the same sale of property, right? $86,375. Okay. So let's do that. We'll save and close, and let's see how my net income is influenced on 2017. All right. Oh, that's because it's just January 1st. Let's go to the entire year of 2017. There's my net income. And I can see, hopefully, let's see, selling price up top. Yep, and there's all my costs. Great, perfect. Okay, so we've gone through a flip. And the biggest thing with a flip is whether or not I'm transferring it to and from the balance sheet, whether or not I have to kind of eliminate that asset or not. Okay, last thing we're going to talk about is refinance. So I have another HUD down here. Usually you get a HUD for refinance as well. I kind of hacked this one together real quick, but I want to just plan on saying that I own this property and I didn't sell it, but I did refinance it, meaning I got rid of this loan here and I got a new loan, in this case for $1.2 million. So let's talk about that. So 2018, I'm fast forwarding, and I again have the same property back on my books. $650,000, $6,400 in closing costs and CapEx. I didn't put the depreciation in here. I'll leave that out for now. All right. And all we do now is we do a new loan. Okay. So we're going to do exactly that. I'm going to take this kind of closing and show you how to do a new loan. Now, this is not the sale. It's a little bit easier than a sale, but we are going to track it with a journal entry as well. An important transaction like this, we want it to be a journal. All right, so I'm going to do this as of 6/30/2018. Okay, notice I got my new loan here. All right, there's no sale of property. I don't have to do anything with my building, with my closing costs, with anything, because that hasn't changed. So a lot of people get tied up in like, hey, I have this property on my balance sheet, but it appraised for something different. What do I do about it? You actually don't do anything with the appraised value of the property. That's the market value, supposedly, but we are not going to do anything with that when it comes to QuickBooks. We're going to keep the book value on our books as we're doing right now, okay? So it actually makes this transaction very easy. The only thing I'm going to do is I'm going to put my new loan in there, this $1.2 million. So this could be like a refinance account, some other kind of long-term liability where I'm going to credit $1.2 million. Okay, that's line one, nice and easy. Now the other part of it is I have to pay off my existing loan, that private money loan. And again, what is my goal? My goal when I'm done with this transaction is to have this private money loan down to zero. It's going to be a combination, just like before, of $785,000 in principal. And by the way, that, figuring this out can take a little bit of time. You're going to get a number here and it's going to be like, where the heck did that come from? Think about, do I owe interest? Is there an escrow balance? Is there something that is a little bit different? Is there a daily interest? Is there a prepayment penalty? Any of that can influence this exact situation. Tax and insurance escrow, we're going to do a negative 2480 on this. Oop, and I didn't do my interest yet. So this is going to be interest. I'm back to like long-term cost of goods sold accounts, 62,800. And we just keep working down. I have an origination fee here for this new loan, 36,000. So that's going to be interest. You could potentially separate out interest and origination fees. I find that keeping them in one place is fine. So this is now here, you're definitely going to have two banks involved. So this first interest, this is due to that private money lender. So you'd put that vendor here, whereas this interest is going to be paid to the new loan. You put that vendor right there. And then we have daily interest as well for this new loan. So I'm going to put interest here and 452.45. Okay. And that's kind of it. And then we get cash. Okay, we didn't sell this thing, but we did refinance. We got rid of this loan. We had a lot of costs associated with it, but the net difference should be cash in our bank account, $318,000 $227.55. Okay, so that's a refinance right there. So what should I see when I save and close this? I want to see the property should stay there. Nothing happened with the property. Property should be on my balance sheet. I got a new loan here. This loan should be gone. I should have quite a significant increase in expenses. My net income is going to go pretty low, but then I have cash in the bank as well. Let's go save and close here and see what we get. Notice there's no income accounts on these. Okay, so cash in the bank has gone up. My building stays exactly the same. My refinance loan has gone up. And if I were to show zeros, my private money loan is here with zero. All right, and then I said my net income is going to be pretty drastically negative, which makes sense on a refinance like this. And that's it. That's refinance. So with a refinance, the magic there is pay off the old loan for sure. That's your main goal, and also realize that there's not any income to record on it. It's just cash moving, right? You don't have to pay taxes on the cash that you get on a refinance. You haven't sold the property yet. All right, those are 3 really good examples. You master those, you can pretty much handle everything. But I do want to remind you that we have end-to-end and really detailed examples of all of this in our course, Real Estate Accounting Bootcamp. Check it out. There's a link there in the description with a $50 off coupon as well. I appreciate you taking this journey with me through all these modules. We have one left that we're going to get to very shortly. Look out for updates on that. And let me know any questions you have, comments. I'm happy to answer anything that I can right here. And I'll see you on the next video.